Okay, we are jumping right into a market that is, well, it's coiling, but flat. S&P 500 futures are basically hugging Friday's close.
Minimal movement.
Yeah, minimal. We're seeing Dow futures tick up, what, a fractional 0.05%?
Yeah.
So a little stability in the value names.
To touch.
But the real indicator, the one we're watching for momentum, the Nasdaq 100 futures. It's dragging slightly, down 0.1%.
And that really sets the stage. As we head into this short holiday week, the sentiment is just, it's firmly neutral.
Right.
And that neutrality is maybe deceptively the entire thesis for today. We didn't get a big catalyst over the weekend.
No.
So the market is still just balancing these two giants that have dominated the fourth quarter. On one side, you have the persistent geopolitical concerns from the Middle East.
Which provides a floor for volatility.
Exactly. And on the other, you have this, unrelenting, high-flying momentum of AI optimism that was set by that late Friday tech surge.
So it's a conflict. On one hand, sticky inflation, elevated valuations.
Especially in growth.
Right. And on the other, this idea of global economic resilience that seems to be driven almost entirely by these huge technological shifts.
That's it. And for you, the listener, preparing for the open, the mission today is simple. Which of those impulses wins?
Yeah.
Does geopolitical risk finally force institutions to rotate out? Or does the AI exuberance just punch us right through those key overhead resistance levels for a year-end breakout?
That structural battle is everything today. So let's look at the implied open money flow. I mean, where is the institutional capital actually gathering before the bell?
Well, the signal is loud and clear. It's a direct continuation trade.
Centered on technology.
Centered on technology, specifically AI and semis. We saw the XLK, the tech sector fund, climb 1.5% on Friday. That momentum is just, it's continuing.
Because the expectations for 2026 are already getting baked in.
And accelerating.
Yeah, and the numbers are backing that up.
Right.
We've seen reports, institutional confidence in 2026 chip sales is near record highs.
Right.
Driven by the infrastructure build-out. I mean, analysts are now projecting global chip sales could break the $1 trillion mark next year.
And when we talk about a structural tailwind, I mean, that is it. That isn't just growth. That's infrastructure defining the next decade.
So what's fascinating there is that to break $1 trillion, the focus has to shift. It's not just the chip designers, not just NVIDIA.
Exactly. It means massive capital expenditure will flow into the entire ecosystem. The high-end manufacturing equipment suppliers, the software layers, the data centers.
It's a systemic uplift.
It is, not just a handful of stocks.
And that sustained growth expectation is showing up right now in our top pre-market gappers. Leading the charge is Quantum Sync AI, ticker QSY, surging 3% this morning.
And the catalyst is an unexpected patent approval for a next-gen AI chip.
That's critical.
It's so critical because it signals a widening moat. In this AI arms race, intellectual property is, well, it's everything. QSY just solidified their position.
But the market isn't a monolith, right? To gauge the health of the broader economy, we have to look outside that AI bubble.
And there you see the fragility.
Absolutely.
Look at Global Commodities Core, GCC. It's dipping 2.5% pre-market.
On an analyst downgrade.
A downgrade citing a softening demand outlook. I mean, this is the real-world effect of that forecasted growth slowdown we keep talking about. When industrial demand softens, it tells you capital spending outside of Silicon Valley is getting cautious.
Which creates that bifurcated market.
Yeah.
A few tech giants carry the index while the rest of the economy kind of decelerates. We should also touch on Secure Health Systems, SHS. It's flat on price, which looks boring, but the pre-market volume is spiking.
And that's because of swirling M&A rumors in healthcare IT. That volume on a neutral price, that suggests institutional accumulation.
Right.
It means even in healthcare, companies are looking to consolidation, to M&A as the way to grow. We could see a lot more of this into year-end.
Okay, let's pivot. From the general flow to the mechanics. Given this tight, neutral sentiment, we have to define our line-in-the-sand levels immediately.
That's the key, because if you don't, you are trading straight into a classic liquidity trap.
Which is designed to do what?
It's designed to lure buyers in above resistance, then reverse sharply, or lure sellers below support, only to see this massive counter rally. We need definitive levels to avoid getting trapped.
Let's start with the S&P 500 futures then, ES. Our critical pivot resistance is 6,915. That's the prior session's high.
And you can't dismiss that level. The prior high acts as a confirmation threshold. So a sustained push above 6,915 on strong volume.
With clear candle closes.
Right. That signals institutional confidence for a breakout, targeting 6,940. But if we just wick above it and fall back,
That's the trap.
that's the trap. Buyers who entered on that wick get liquidated immediately.
And on the downside, where's our floor?
We're looking at 6,860. This is important because it's Friday's value area low, the VAL.
The price where most of the trading volume happened.
Exactly. So failing to hold the VAL suggests that Friday's conviction is truly breaking down.
So a bounce off 6,860 confirms underlying demand is still there. But a clean break below it suggests a bearish shift, targeting 6,830.
And right now, we're hovering tight between those two levels. It's the definition of a consolidation zone, a liquidity trap environment. You need a sustained break on heavy volume to trust the direction.
Okay, shifting to high beta tech, the Nasdaq futures NQ. If the AI story is going to break us higher, the NQ has to lead.
It has to. And the overhead supply we need to clear is 20,180.
Why that number specifically?
It's a recent swing high, but it also aligns with a key Fibonacci extension. That indicates concentrated supply from traders waiting to take profits. A definitive breach above 20,180 is the breakout signal for tech.
Targeting 20,250.
Thus, without that powerful push, the whole AI narrative stalls.
And the support we have to hold.
In 20,050. It corresponds to the recent consolidation low and, critically, the developing 20-period moving average. Holding that gives you a launching pad.
And a failure.
A failure there, especially if the 10-year yield starts climbing, could accelerate declines down toward 19,980 fast.
The indecision near these highs it screams buy trap potential. If we poke above 20,180 without that heavy institutional follow-through,
Sellers will step in immediately, trapping the buyers and confirming that liquidity trap setup.
Okay, so we have the index ranges, but the real action, the gap and go potential, is in the tickers.
Let's get into it.
Let's start with the market darling, NVIDIA, up almost 4% pre-market.
And the catalyst is massive. A Reuters report suggesting the U.S. is reviewing sales of advanced AI chips to certain approved customers in China.
This is a huge strategic development.
It's huge, because for the last year, that regulatory risk around China has been the main anchor on the stock. If those restrictions ease, even a little,
It opens up a massive market segment.
a market that was totally off limits, it mitigates a huge long-term risk.
Go on the chart, what does that mean? The bull target is $1,350.
That's the challenge point.
And the bear case support, where profit takers might step in, is around $1,280. If that fails, the news was probably priced in too fast.
Now, shifting gears completely, let's talk Eli Lilly, LLY. This stock is all about aggressive strategy in that exploding pharma space.
The GLP-1 anti-obesity market.
For 2026 and beyond, the buzz this morning is about potential M&A rumors involving a French biotech, ABIvax.
And then ABIvax shares surged 10% on that. So what's LLY's motive? They already dominate the space.
They want to solidify their dominance. It's about diversifying their pipeline against intense competition, from Novo Nordisk.
So they're buying up future threats.
Or complementary tech.
Yep.
The GLP-1 market is projected to be one of the largest drug markets ever. They want every piece of it.
So if the acquisition news confirms, LLY could push toward $870.
But the risk in pharma M&A is always integration or a competitor's surprise launch. That could pull it back to $810 just as fast.
Okay, and finally Palantir, PLTR, trading up over 4% pre-market, implied open around $193.
They've really cemented their spot as a key AI winner of 2025. Strong revenue, strong profit momentum.
Palantir is a true momentum trade. The bull case here is a challenge of that 12-month high near $205. But this is where it gets tricky.
Because valuation concerns collide head-on with pure momentum.
Exactly.
It's the classic high beta dilemma. The narrative is fantastic, but the stock is always scrutinized for its valuation. And you see active put options, some insider selling.
Yeah.
There's real downside risk there.
So we have to watch that $205 ceiling very, very closely if the institutional backing isn't there to push through.
The risk of a swift pullback to $185 is very real, especially for a name that runs so much on sentiment.
Now, we absolutely cannot talk about these valuations and price targets without connecting it to the macro, to the cost of money.
That is the ultimate arbiter. Let's look at the 10-year Treasury yield. It's sitting around 4.16%, 4.17%.
And this is a major structural point. Despite amazing NVDA news, that rising yield is a huge headwind for tech. Why?
It's simple. Higher yields increase the cost of capital. But more importantly, when you discount the future earnings of a growth stock,
Which is all an AI name is.
right, it's a promise of future profits. You use the current risk-free rate, which is tied to the 10-year. A higher yield means those future profits are worth less today. it pressures valuations
Mm.
instantly.
It creates a constant drag.
Yeah.
But there is a factor providing a cushion here, and that's the dollar index, the DXY.
Right. The DXY is trading between 98.47 and 98.63. And crucially, it's down 1.66% over the past month.
And that weakness acts as a powerful tailwind for tech.
Because most of our big tech companies, like NVDA, are multinational. A weaker dollar means their overseas revenue earned in euros, yen is worth more when converted back to dollars.
So it boosts their reported earnings.
So you have this dynamic. The dollar weakness is providing this necessary offset to the pressure from rising yields. It's what's keeping everything glued together in this tight range.
But that raises the most important question for the open.
Which is?
If that 10-year yield really spikes from here, how quickly does that protective offset from the dollar just disappear?
And if it does, you run straight into the pain trade.
Explain that.
The pain trade is what happens when institutional money makes a hard, fast rotation. If the 10-year moves towards, say, 4.25%, capital managers will rotate out of long-duration assets, tech, growth, and into value, into cyclicals.
And the trap for the individual investor is buying the dip.
Exactly. They buy the dip in their favorite tech names, they believe the NVDA narrative is invincible, and they ignore the rising cost of capital. They get caught on the wrong side of that major reallocation. The lesson is always, don't fight the rate trend.
Okay, let's bring it all home for you. We're in a tight, neutral pre-market, defined by this conflict between geopolitical risk and AI-driven upside. The mission is precise.
Define the range.
Define the range. On the S&P, that's 6,915 and 6,860. On the Nasdaq, 20,180 and 20,050.
And we've identified the pockets of capital flow in NVDA, PLTR, and LLY. We understand the macro forces, rising yields countered by a weakening dollar holding this all in place.
So if we connect this back to that liquidity trap setup, the ultimate question for you today is focused entirely on one thing: volume.
Given the power of this NVDA catalyst and the structural tailwind for AI, will today's momentum have the institutional capital depth, the genuine volume follow-through, to confirm a real breakout above those resistance levels?
Or is it just a high-volume fake-out, designed to trigger stops and lure in short-term buyers?
Before a sharp, painful reversal back into the range, stay sharp and monitor that volume profile closely today. The market will not respect conviction unless it's backed by cash.